Two companies, same 10% jump in sales. Company A's profit surges 50%. Company C's profit climbs 25%. Same sales bump, very different results. The gap isn't luck, it's something called operating leverage. And today I'll show you how it works. Hi, I'm Randy, your guide to mastering business numbers. Welcome back to Profit and Pricing Essentials. Last time we found your break-even point and margin of safety. Today we tackle operating leverage, the amplifier that makes profits surge when sales rise and crash when they fall. No debits, no credits. Now if you're ready, let's begin. So what is operating leverage? Every business runs on a mix of fixed costs and variable costs. You already know the difference from episode 1. Operating leverage is about what that mix does to your profit when sales change. If your business carries heavy fixed costs like rent, salaries, and equipment payments, then once you clear the break-even point, extra sales pour straight into profit. That's the upside. The downside, when sales dip, those fixed costs don't shrink. Profit drops real fast. And a profit with mostly variable costs doesn't swing as hard in either direction. Steadier, but the profit jumps are smaller. Operating leverage puts a number to that swing. We measure operating leverage with something called the degree of operating leverage, or DOL. Here's the formula. DOL equals contribution margin divided by operating income. As a quick reminder, contribution margin is sales minus variable costs, and we cover that in episode 3. Today we're using the total contribution margin for the whole business, not per unit. Operating income is what's left after you subtract fixed costs from that contribution margin. A higher DOL means profit moves faster than sales in both directions. If your DOL is 5, a 10% jump in sales creates about a 50% jump in operating income. But a 10% drop in sales, that's a 50% drop in profit. To make this concrete, let's look at 3 companies. Each one brings $1 million in sales and earns the same operating income, $100,000. The only difference is the cost structure. Company A carries heavy fixed costs, big facility, salaried crew, owned equipment. Its DOL is 5. Company B has a balanced mix. Some permanent staff, some hourly, owns some equipment, rents the rest. DOL is 4. Company C runs lean, subcontract labor, rented equipment, flexible overhead, DOL of 2.5. Same profit today. Now let's see what happens when sales move. Sales rise 10% across the board. Company A's profit jumps 50% from $100,000 to $150,000. Company B's profit climbs 40% to $140,000. And Company C's profit, it rises 25% to $125,000. The higher the leverage, the bigger the payoff. Now flip it. Sales drop 10%. Company A's profit falls 50%, cut in half just to $50,000. Company B drops 40% down to $60,000. Company C falls 25% to $75,000. Same swing, opposite direction. The company with the highest leverage got the biggest reward on the way up and took the biggest hit on the way down. That's the trade-off. High operating leverage is a profit amplifier when sales are strong, but when the market shifts underneath you, it turns into a trap. Think about large retail chains that built massive stores around foot traffic. When buying moved online, those fixed costs, the leases, the staff, the build-outs, didn't shrink with the sales. The response wasn't better math. It was smaller stores and a lower fixed cost footprint. Or picture a restaurant that's now too big for its customer base. Rent, utilities, and staff don't care that the dining room is half empty. As my father-in-law used to say, That's a large nut to crack. In those situations, operating leverage isn't a strategy. It's a warning sign. When your environment changes, your cost structure needs to change with it. You don't need perfect data to put this to work. Here's a quick exercise. Open a spreadsheet, enter your total sales, total variable costs, total fixed costs, calculate your contribution margin and operating income. Divide contribution margin by the operating income. That's your DOL. Now run two scenarios. Sales up 10% and sales down 10%. Watch what happens in profit in each case. If the downside scenario makes you uncomfortable, you're carrying more risk than you might realize. Consider shifting some fixed costs into the variable bucket. Renting instead of buying, using subcontractors instead of full-time hires, or choosing cloud tools that scale with activity. If the swings feel manageable and your sales are steady, you may have room to invest in more fixed capacity and capture stronger margins on the upside. Before we wrap up, here is everything we covered in one checklist. List your fixed costs, list your variable costs, calculate your contribution margin, compute your DOL, run a 10% up and 10% down scenario. Decide if your cost structure fits your sales pattern. Use this once a year or anytime you're making a big decision about staffing, equipment, or facilities. 10 minutes of math can save you months of stress. Which statement fits your business? Type A for mostly fixed cost, type B for mostly variable cost, or C for not sure yet. No dollar figures, just one letter so we can see the mix. Next time we're getting into job costing, the gap between what you expect to make on a project and what you actually made. If you've ever finished a job and wondered where the margin went, that one's for you. Thanks for watching. Well, until next time, have a great day.